how does a HELOC strategy work and the step-by-step process.
All right, so you understand how a HELOC works, why it's better and more efficient than a mortgage, but you're probably asking yourself, what are the steps of execution and what it looks like to, to work with us. Again, we go back to number one is education. Although we're developing softwares, potential SaaS company, banking features, things like that to automate it, I never want to be dependent on technology. It's like we had this scenario where this bank was calculating debt ratio wrong because the computer was doing it. And in talking to the banker, I was like, do you not know how to do this by hand? I was like, I said, have you got this for expense? You got that for expense? Have you got this for income? Here's what I'm averaging over the last 2 years. Here's the pay stubs. Here's the tax returns. Yep, I'm getting all that. Okay, then why is the computer saying this debt ratio, let's say 57% versus 43? I don't know, that's what the computer says. I was like, well, do you know how to do this by hand? The answer is no. They don't know how to do it by hand. Come to find out, it was wrong. The computer was wrong because it was simple third grade math to get to the debt ratio. And debt ratio is like basics for a loan officer, but bankers don't know how to do it. This is why I say loan officers are smart, bankers are stupid. So I never want to be dependent on education in automation because if something were to fail, I want to know how to actually execute on this, in an analog fashion. So education is number one. Understand why the two are different. And if you understand why they're different, you can play little games to maximize the efficiency. Getting ahead, but let's just say offset accounting, right? Offset accounting is, that money going into the home equity line of credit suppresses the balance, therefore suppresses the amount of interest that you pay. But you also know that you got to pay bills. So if money's coming out to pay bills, then what happens to the balance? It goes up, right? Then interest goes up, albeit still more efficient and cheaper than a mortgage. But is there little games that we could play to minimize that? And that's where we come up with offset accounting, utilizing offset accounts to pay the bills. The bills still get paid while the income still suppresses the balance of the HELOC. And it may sound like robbing Peter to pay Paul, but if you understand the calculation, which again is not hard, then you see why you gain anywhere from 10 to 15% more efficiency. I mean, that sounds like a big deal, but let's just say you run the numbers and you got 15 years to pay off. Well, this could speed it up another year and a half. Okay, if you're thinking 10 years out, doesn't seem like a big deal, but what if I said, dude, I forgot your freaking name. Derek. Yeah. If I said, Derek, you can retire today. You're done. You get to go home, the wife, kid, just hang out. Go to the beach, whatever. You're retired. Your obligations are over with. How excited do you get? You get super excited, right? I said, dadgummit, I was wrong. Actually, it's another 18 months. That 18 months feels like eternity now, right? So it's understanding the efficiencies there. So education is key. Number two is design, okay? Because there's very few HELOCs that are similar to another one. So Bank A has a different one than Bank B, and Credit Union C has a different one than Bank A and B, right? HELOCs are vastly different. Whether it's the LTV you got, LTV is loan to value, which is the line limit to what the balance is. What are you paying off with it? Some people only think, well, I only use this to pay off my mortgage, right? I don't know, maybe not. What else you got? You got some car loans that have high interest rates or even low interest rates for that matter. You got some student loans. Student loans I'm not a big fan of, but credit cards, who knows? So there's different scenarios for every unique situation. So design is key. Then follow the process. This is where people get hung up. And I relate it to sports. I played basketball for a very long time. Not at the highest level. Highest level would be NBA. Never got there, but played college ball. And so over the course of playing not just basketball, but other sports, you have your good coaches and you have your bad coaches, right? Well, we're a good coach. And when you find that good coach, you no longer ask why. Unless your goal is to eventually become a coach, you don't ask why. You just do because he's got your back. It's the team's best interest to do what he's telling you to, or she is telling you to do. That's this. That's who we work best with. Don't overanalyze it. Learn it. Ask good questions, that's fine. But don't second guess it because in 10 plus years, We've had financial planners, financial analysts. Heck, I went up against American Express, one of their top financial analysts, because they were financial planning for one of their bigger clients, and their bigger clients came to me and was like, this makes a lot of sense. I should probably do this. And so he got a second opinion. Next thing you know, we're on 3- and 4-way phone calls with the financial analysts and destroyed them because it's just simple math. So we've had it all thrown at us. So feel free to second guess it, but just don't get in your own way by overanalyzing, or they call it analysis paralysis. Just do it and watch what happens. If it doesn't happen, which never happens, but if it doesn't, then feel free to be like, why isn't it happening? And let us dissect it. So design is the next phase. Then once you got a design, we need to pick out the bank that makes the most sense for your unique situation. Like I mentioned before, there's a bank in New York that does 0% for 12 months. Okay, that's a good fit for our clients that can qualify that are only in New York. That has no impact on the ones in Pennsylvania or Florida or California or anywhere else. And we do business in all 50 states. So we need to identify the bank that makes the most sense for your situation. Too often I hear about, oh, my brother was a client of yours who lives in Tennessee. I live in Ohio, and he went with Bank of America. He just handed you a loaded gun and you've never been on a range. You have no idea what you're doing. In his situation, do you have the same job as him? Do you have the same income as him? Do you have the same expenses as him? Do you have the same hopes, dreams, and goals in financial future that he has? It has to be identical, because if anything is off, then that bank may not have been the best fit for you, nor would they be the best fit in your state. We like small community banks and credit unions, healthy ones. You listened to one of my consultations with a potential client before this. So you heard me talk about health of a bank is important. What they have on balance sheet as far as loans out versus depositors in, because there are going to be banks that fold. Not that it truly disrupts your HELOC, because that's an asset to another bank. They're just going to buy that paper and not really change the contract. But nonetheless, we look for that. And we also look for ones that are consumer friendly. Also, the income makes a big difference too. Let's say your brother, who's in Tennessee, makes $30,000 a month and has $10,000 of expenses. You make $9,000 a month and $5,000 of expenses. His interest rate does not matter to him, because he's decimating the balance so fast. He's what's called interest rate immune. It doesn't matter if it's 3% or 9%. It's going to change whether or not he pays the home off in 17 months or 17 months in 1 week. He don't really care, right? You, on the other hand, it does make a difference. Maybe we do promo rate stacking with you because the numbers are a little tighter, and we need to get it, below 7 years, versus if you were at his interest rate with the bank that he recommended to you because you didn't talk to us and didn't know what you were doing, and he didn't quite know what he was doing because he hasn't mastered it yet. Now you're at 11 years. Let's go back to when I told you had 18 months. Felt like eternity. Imagine another 6 years. When I said, oh, you get to retire today. Oh, my calculation was off. It's 6 years. You're ready to jump off the top of the roof. So, you've got design. Now we got to pick the bank. Then we've got to execute. But we have to execute on a very specific day. Now, this doesn't actually save you money. I've heard some people out there, especially on YouTube University, talk about, oh yeah, this can save you 2 months payments if you close on the right day. It doesn't save you anything. It just gives you a reprieve. So if you close on a very specific day, you can go 2 months without paying the HELOC. Some people like that, some people don't. I don't care, it's 6 in one hand, half a dozen in the other. It's just a reprieve. Money's not going out, but neither is the balance going down. So it doesn't save you any money. Now, there is a cool situation where we help some people in certain states, specifically Texas, where they can buy a home with a mortgage at no closing costs, and we show them how to do that with a lender, because keep in mind, I was a lender for 17 years, so I know how to do what's called lender rebates and make sure that the closing costs are next to nothing, if not nothing. You get 2 months free on that one. Then we flip the mortgage, which don't ever tell your mortgage loan officer this, because they'll never want to do business with you, because if the loan is paid off in 6 months, they don't get a commission. Yeah. So you get 2 months from the mortgage lender, but then you refinance the mortgage inside of the 2 months and get another 2 months. Your first 4 months inside of a new home, you don't have to make any payments. Again, doesn't save you money. It just means you're not making the payments. So balance isn't going down either. So we have to, also take a look at what your goals are and when you want to close. Do you want that reprieve or not? Some people care, some people don't care. And now we got to execute. So now we're going back to the education and saying, okay, when is money going in as fast as possible? When is money coming out as slow as possible, right? So, and then things come up along the way. So we revisit with people whenever they want. So we have a dashboard that people can tap into us. I wouldn't say 24/7, but it feels like it. I've got a really good team. I'm usually up until 9:30 responding to messages, but they are too. So please don't use and abuse that. But we are there at the beck and call because things come up, opportunities or life moments. You heard me explain the scenario during COVID. Things come up, income goes down. What do I do? How do I pivot? Okay, let's talk this through. Here's what you do. Or here's an opportunity. Just like this individual I was consulting with prior to this interview. He's in the trucking business, in the freight business. And I was like, okay, have you thought about leverage? Because most people look at us from the outside in and think it's a debt-free strategy. I don't want to be debt-free. Cool. Me either. Not right now. Did it once. It was okay. I want to do it again at a different life cycle that I'm in. Right now, I'm still hustling, still trying to build a business and multiple businesses. So I'm not concerned about being debt-free. I understand the power of debt for my businesses. So I asked the question, have you thought about leverage? And he's like, yeah. He's like, I started in the trucking business 2 years ago, wanted to get my feet wet. I kind of understand it. And yeah, I would like to buy another truck. I thought he was going to say buy a truck for him to sit in, but he actually took it maybe a step further where he's like, I want to buy another truck for somebody else to sit in. So I'm still making money here while I'm passively making money on this other person sitting in that truck, driving that truck around. I like that. That's good. So let's do the math. Let's do a business analysis that, however, use easy numbers, 50 grand. I doubt you can buy an 18-wheeler for $50,000, maybe a down payment. But let's say $50,000, and you heard the analysis, like, look, $50,000 on a HELOC is probably going to cost you $140 a month. So is this new asset that you're buying going to bring in well over that? Let's say it's $1,000. That makes sense. That's a good business analysis. Yeah. Then we should turn this liability into an asset, and it's a cash flow asset, which actually will speed up the payoff process because what went up? His cash flow. And what you'll learn in the education is there's two gaps in this. The first gap that's most important is the amount of money coming in versus the amount of money going out. That is the most important gap. And that's where budget comes in. That's where I'll tip my hat to Dave Ramsey. Budget, there's no sidestepping that. You have to be on a budget and you have to be somewhat disciplined. The second gap is time of money in versus time of money out. I've already said it. You want money to go in as fast as possible. You want it to come out as slow as possible. That speeds up the process. So doing that analysis, $140 a month, incurred debt, your balance goes up, plus your minimum payment goes up by $140 while the balance is still there by $140, but you increase cash flow $1,000. Well, guess what happens to the balance? It actually speeds up. The trajectory of the balance goes down at a steeper rate. Now that it's going down at a steeper rate, why stop at one truck? Let's get 5, right? Now let's get you out of that seat so that you're not trading your hours for dollars. And so many people in America, that's what they do. Because they don't think that, one, they don't know any better, but they also don't think they can. I wasn't born any different than anybody else in this country. I was born from a mother and a father. I can guarantee you weren't born from a father and a father or a mother and a mother, right? We're all born the same way, or else we're just not born, right? So I wasn't born any different. My upbringing didn't give me any type of advantage to execute in this any more than anything else did. Maybe some experiences prepared me, whether it's sports and competitiveness or, I was going to say going to college, but outside of networking, I can't really see a benefit there either. So many people are, especially like your motivational people are like, well, I'm a 1%er and there's very few people in this world that can do what I do. Bullshit. I think everybody can. It's just, is everybody willing to go through what you're willing to go through in order to get to where you want to go? That's the difference. Everybody has the ability. So where was I? So the steps: design, execution.
Design,
Yeah.
find a bank, execution.
Yeah, and so the ongoing process that things change, just like this individual, he's first going into it like, let's decimate this debt, but then now that I'm thinking about leverage, what does that look like? That's where we really get to have fun. And now let's take you from employee to business owner. Employee, employer, business owner, and the Holy Grail, investor. That, as I told him, and you were here, I'm not there yet. Do I invest? Yes. Am I 100% making my money from investments? Absolutely not. The bulk of my money comes from being an owner of this business. So I'm still in the business, and that is not the Holy Grail. It's a step closer, but I'm not there yet. So that was explained. That's when it gets really fun, is when you start looking at now having access to capital, what you can do with it. And quite honestly, that's got two sides to the coins too, because we do get calls like, hey, I've got X amount in the bank, X amount of income, I've paid this off, I'd like to buy a boat. You gonna make money with the boat? No, I'd just like to buy a boat. Dude, I'm gonna treat you like an adult. You're not gonna be on a live radio show with me. I'm like, that is just stupid. The two best days owning a boat is when you buy it and when you sell it. No. That's up to you, man. You're an adult. If you can handle it, do it. Great. You got kids and you make some great memories. Those are investments too. Purely money and financial, if you're looking for us to advise, we're probably, no, if it's not making you money, don't do it. But there's emotional reasons to do stuff too. I had because here's something else. We have a lot of people that invest in real estate. So they may have HELOCs on their rental properties and also a HELOC on their primary residence. And they're like, which one makes the most sense to pay off first? Because some people will look at that and say, okay, well, I'm going to spread all my money out on all the properties and then pay them down like this. It's actually, I wouldn't say inefficient, it's less efficient than Dave Ramsey's snowball method, which is focus on one at a time. And so the question she asked me was, which one should I focus on? I said, I'm going to give you two answers. There's the financial decision. There's the emotional decision. The financial one, the mathematical one, is you tackle the highest cost of funds first. So let's say you got a rental property over here that has a HELOC rate of 6 or 7%, but you got a 1.99 on your primary residence. Math says to pay the rental off first. The emotional one, and again, this is a personal decision for me, is I've got a wife, 5 kids, and I've been broke before. I've had a home foreclosed on. I've had cars repossessed, negative bank accounts, didn't even want money deposited in my bank account because it would just vanish because I was upside down in my bank account. Don't want to go there again. So the house, primary residence where my wife and kids lay their head, that gets taken care of first. That's an emotional decision. Neither one is wrong. It's just what's best for you. And again, we're going to treat you like an adult. We're not going to talk down to you. We're going to tell you what the mathematical one is and what the emotional one is and allow you to make the decision for yourself. So a lot of steps along the way, and things change. That's why the steps get longer, because people evolve. Then it's, okay, now I want to have legacy planning. Okay, how can I utilize my HELOC for legacy planning? Okay, have you thought about the insurance portion of this? The infinite banking concepts that we teach? No, I haven't. How does that work? Cool, let me get in touch with the right person. Although I'm licensed, I'm not going to be the one to teach you that. I can give you the basics, but I'm not going to teach you that. I've got experts that have been doing it for 2 decades. That's what they're going to do. Then we're going to take maybe some capital from the HELOC to put into the insurance policy, or take loans from the insurance policy to pay off your home. It just depends on where you're at in your life cycle and what's best for you. And we team up to make sure that you have the best information and you make the best decisions for your family. So to have steps 1 through 10, well, that's easy to do. But what we don't know is everybody's situation is unique, and it doesn't stop at 10. It could go to infinity, and that's what we're always around for. So it's very holistic. So having said all that, if you're like, you know what, I'm convinced, I want to give this a try, because there's 2 realities that you will face. One, you can't deny the math. And then later on, usually it's about 6 months later, you're like, reality hits you. That's the second reality, is that you're executing. You're like, holy crap, this is as advertised. And in fact, It's actually a little bit better because we tend to be conservative with our numbers because we know that humans will be humans. And when people tell us they make 10 grand, they probably make 9,800, right? So that $200 might make a little bit of a difference. Or vice versa. You know, they picked up a side hustle and now instead of 10 grand, they, you know, believe it or not, there are some people that they say they make 10 when they make 12. I like those people. I think they're cool. You don't see them coming. That's who I aspire to be, is those people. So things will happen probably faster than we actually advertised. That's the second reality that people see. And then they're like, all right, what's next? And that's when the game really just got started. People think that's where it ends. It's like, I get the HELOC and I start executing, game over. That's where it actually starts. And so if that appeals to you, by all means, reach out to us. ReplaceYourUniversity.com. Pick the vertical. Most people, 98% of the people that know about us, they're interested in the HELOC stuff, the replace your mortgage stuff. They're convinced on that. Cool, start there. That's a great foundational piece. Start there, and we'll go at your pace. Even if it's just replace your mortgage, we even go at your pace on that too. Some people, they can get through it in a couple weeks. Some people, it may take them 6 months, but that's okay.